Assalamu alaikum. This is Mohammad Kaleem Khan, faculty member, Faculty of Management Sciences, ILMA University. Today, we are going to discuss the first lecture of Principles of Accounting. In today's lecture, we are going to learn the definition of accounting, the users of financial information, the organizations that govern accounting procedures, accounting concepts and principles, accounting equation, including assets, their types, their categories, their characteristics, liabilities, equity, and topics concerning to accounting equation. Let's start with the definition of accounting. Accounting is a process of recording financial transactions pertaining to a business. The accounting process includes summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection authorities. Accounting is one of the key functions of almost any business. It may be handled by a bookkeeper or an accountant at small firms, or by a sizable finance department with dozens of employees at larger companies. The reports generated by various streams of accounting, such as cost accounting and managerial accounting, are valuable in helping management make informed business decisions. The history of accounting has been around almost as long as money itself. Accounting history dates back to an ancient civilization. During the Roman Empire, the government had detailed records of its finances. However, modern accounting as a profession has only been around since the early 19th century. An Italian mathematician, Leonardo da Vinci, published a book on the double entry system of bookkeeping in 1494. The information system of accounting has the following characteristics. It measures business activity, it processes the data into reports, it communicates the results to decision makers, and it presents information in monetary items. Moving forward to the users of financial or accounting information. The decision makers or users of accounting information are individuals, means general public, businesses means business management, creditors, investors, tax authorities, or government agencies. First of all, we are going to start financial information users with individuals. The individuals or public is impacted by business in a number of different ways. For example, businesses have a significant positive impact on the community's economy through their employment of local and the use of suppliers and creditors. Financial statements can help the public by informing them of recent changes and trends that have affected the enterprise success and scope of its activities. The second users of accounting information is business management. In order to assess the firm's short-term and long-term solvency, management needs information regarding the firm's activity. Management needs accounting information to make several decisions, like determination of selling price and other strategies. It is also needed for comparison of performance with similar enterprises in the industry, and to make plans for the future regarding expansion, reduction, etc. etc. Now, the third one is creditors. Creditors are interested in firms' financial records in order to decide whether to prolong, sustain, or restrict the flow of credit to a specific firm. Short-term and long-term creditors need to know if the amount owed to them will be paid when due or not. To ascertain if their principal amount and interest accrued will be paid when due, and whether to prolong, maintain, or restrict the flow of credit to a firm, short and long-term creditors needs information. Such information helps them to understand the paying ability of the enterprise. The next one is investors. Investors are investing in your business and they are interested in the financial records of the firm in which they are going to invest. In order to assess the pros and cons of their investment and decide whether to buy, hold, or sell the shares, investors require accounting information. Tax authorities are interested in accounting records of the firms to determine an enterprise tax abilities. In order to compare the information on tax returns with the supporting accounting records, tax authorities occasionally audit the returns filed by the firm. The accounting records of the supplier and the customers are also cross-checked by tax authorities to spot suspected tax evasions. There are two fields of accounting, or there are two types of accounting. The first one is financial accounting and the other one is managerial accounting. Financial accounting provides information for external decision makers, and they are investors, creditors, tax authorities, competitors, or suppliers. While on the other hand, managerial accounting focuses on information for internal decision makers like managers or business owners. There is a small question for you. Suppose you are the manager of Greek Tunes. The company needs a bank loan in order to purchase music equipment. In evaluating the loan request, the bankers ask about the assets and liabilities of the business. In particular, the banker want to know the amount of business on the security. Now you are required to answer: is the banker considered an internal or external user of financial information? And financial statement, which financial statement would provide the best information to answer the banker's question? As we know that the banker is not internal party of a business. Banker is not directly involved with your business. So bankers is an external user of your financial information. Answer to the next question is: which financial statement would provide the best information of the question of the banker's question? The balance sheet that include assets, liabilities, and equity, because bankers are interested in assets to equity ratio, assets to liability ratio, liability to equity ratio to confirm loan to a party. Now, moving forward, accounting profession and the organization that governs it. Accounting profession is a well-paid career with many opportunities. There are two main certificates, certified persons, certified agencies, popular in the world. Number one is certified public accountants or CPAs, and the other one is certified management accountants or CMAs. CPAs or certified public accountant is the title of qualified accountants in numerous countries in English speaking world. It is generally equivalent to the title of chartered accountant in other English speaking countries. In the United States, the CPA is a license to provide accounting services to public. In Pakistan, they are called chartered accountants. The other one, certified management accountants, is a professional certification credential in the management accounting and financial management fields. The certification signifies that the person possesses knowledge in the areas of financial planning, analysis, control, decision support, and professional ethics. There are many professional bodies globally that have management accounting professional qualifications. Governing organizations, governing authorities who made rules for accountants are: number one, the first one is Financial Accounting Standard Board, FASB, established in 1973. It is an independent private sector, not for profit organization that establishes financial accounting and reporting standards for public and private companies and not for profit organizations, means NGOs, that follow generally accepted accounting principles. FSB is recognized by US Security and Exchange Commission as the designated accounting standard setter for public companies. FSB standards are recognized by authorities in many organizations, including State Board of Accountancy and American Institute of CPAs. The FASB develops and issues financial accounting standards through a transparent and inclusive process intended to promote financial reporting that provide useful information to the investors and others who use financial reports. SEC, Security and Exchange Commission. The US Security and Exchange Commission, SEC, is an independent federal government regulatory agency responsible for protecting investors, maintaining fair and orderly functioning of the security markets, and facilitating the capital formation as well. It was created by Congress in 1934 as the first federal regulator of the security markets. The SEC promotes full public disclosure, protect investors against fake and manipulative practices in the market, and monitor corporate takeover actions in the United States or in all over the world. It also approves registration statements for book runners among underwriting firms. Generally, issues of securities offered in national commerce through the mail or on the internet must be registered with SEC before they can be sold by the investors to the investors. Financial service firms such as broker dealers, advisory firms, or assets managers, as well as their professional representatives, must have registered with SEC to conduct business. The next one is AICPA, American Institute of Certified Public Accountants. It is also a non-profit professional organization representing certified public accountants (CPAs) in the United States. The American Institute of Certified Public Accountants was founded in 1889 under the name American Association of Public Accountants. The organization is integral to rulemaking and standard setting in the CPA profession and serves as an advocate for legislative bodies and public interest groups. Moving forward to GAAP means generally accepted accounting principles. GAPs are standards that encompass the details, legalities, and business corporate of accounting. The Financial Accounting Standard Board uses GAAP as the foundation of its comprehensive set of approved accounting methods and practices. The International Accounting Standards are the next one. International Accounting Standard Board. They set rules for financial statement that are replaced in 2001 by International Financial Reporting Standards, means IFRS, and have subsequently been adopted by most major financial markets around the world. Both sets of standards were issued by the National Accounting Standard Board, an independent body based in London. The United States does not follow IFRS. Instead, the US Securities and Exchange Commission require public companies in US to follow generally accepted accounting standards. China and Japan also declined to adopt IFRS. Accounting concepts and principles. Accounting concepts, generally accepted accounting concepts and principles are guidelines that govern accounting. They are based on conceptual framework and their aim is to provide useful information and investment and lending decisions must be relevant, reliable, and comparable. The first accounting principle is business entity concept. The business entity concept states that the transactions associated with a business must be separately recorded from those of its owner and other businesses. Doing so required the use of separate accounting records for the organizations that completely exclude the assets and liabilities of any other entity or the owner. Without this concept, the record of multiple entries would be amalgamated, making it quite difficult to distinguish the financial and taxable results of a single business. The next principle is faithful representation principle. It is a concept that defines financial statement be produced that accurately reflect the conditions of a business. For example, if a company reports in its balance sheet that it had 1.2 millions of account receivable at the end of the month June, then that amount should indeed have been present on that date. The faithful representation concept should extend to all parts of the financial statements, including the results of operations, financial positions, and cash flows of the reporting entity. Next important concept of accounting is cost principle. It is an accounting principle that records assets at their respective cash amount at the time the assets was purchased or acquired. The amount of asset that is recorded may not be increased for improvement in market value or inflation, nor it can be updated to reflect any depreciation. Assets that are recorded can include short-term and long-term assets liabilities, or any equity, and these assets are always recorded at the original cost. Oftentimes, the financial record may track the depreciation or going value of acquired assets. However, the cost principle will remain the same. Additionally, the cost principle is also referred to as the historical cost principle, meaning that no matter the appreciation or depreciation an asset is going through over time, the original cost of the assets at the time of acquiring it, the value of its keeps the same according to cost principle. Moving forward to going concern concept. Business will go on. Business will not be stopped. This is the main line of going concern concept. It is an accounting term for a company that has the resources needed to continue operating indefinite time until it provides evidence to the contrary. This item also refers to companies' ability to make enough money to stay afloat to avoid bankruptcy. If a business is not going concern, it means it has gone bankrupt and its assets are liquidated. Stable monetary unit concept, or simply monetary unit concept. This principle states that you only record business transactions that can be expressed in terms of currency. Thus, a company cannot record such non-quantifiable items as imply skill level, the quality of customer service, the creativity of engineering staff, or a business cannot record the monetary value of a valuable speech given to the employees about how to engage in innovative activities. The monetary unit principle also assumes that the value of the unit of currency in which you record transactions remain relatively stable over time. However, given the amount of determined currency inflation is almost in almost economies, this assumption is not correct. For example, a dollar invested to buy an asset 20 years ago is worth considerably more than a dollar invested today. Because the purchasing power of the dollar has declined during the intervening years. Our next point is accounting equation, definition of assets, liabilities, and equity. The accounting equation is a formula that shows the sum of a company's liabilities and equity are equal to its assets. The clear-cut relationship between the company's liability, assets, and equity are the backbone to double entry bookkeeping. The source of a company's accounting equation numbers is its balance sheet. Equity can also named as shareholders equity, stockholders equity, or owners equity. Like other equations, if two terms of the basic accounting equations are known, you can solve it for the third one. For example, total assets minus total liabilities is equal to total equity, or total assets minus total equity is equal to total liabilities. You move a term from the right side to the left side of the accounting equation by using a minus sign. Now discussing the first items of the firm's accounting equation, that is assets. Assets are called economic resources of the business. It is one of those words that have both casual meaning and specific definition. As a part of everyday speech, assets is usually used favorably, means he's a real asset to the community, he's a real asset to the organization. But in the business accounting sense, what do finance professionals mean by assets? In this context, an asset is something that has value for the firms, and it provides benefit in future. The International Accounting Financial Accounting Standard Board defines assets as a resource controlled by the enterprise as a result of past events and from which future economic benefits are expected to flow the enterprise. Assets are divided into two parts: fixed assets and current assets. Current assets are the assets that a company holds and can be easily sold or consumed and further lead to the conversion to liquid cash. For a company, a current asset is an important factor as it gives them a space to use the money on a day-to-day basis and clear the current business expenses. In other words, the meaning of current assets can be explained as an asset that is expected to last only for a year or less. Current assets include cash and cash equivalents. Inventory means merchandise, means goods bought for resale purpose. Ongoing projects. Prepaid expenses. Prepaid expenses are expenses paid in advance. Account receivable and marketable securities. In sum, current assets can be used as clear, regular payments and bill. It gives an insight into the company's cash and liquid position. Investors and creditors analyze the company's current assets closely to understand the risk and benefits involved in the operation. Other type of assets is fixed assets. Fixed assets refer to long-term tangible assets, means physical assets that are used in the operations of a business. They provide long-term financial benefit, have a useful life of more than 1 year. Fixed assets are crucial to any company apart from being used to help business generate revenue. They are closely looked at by investors when deciding whether to invest in a company or not. For example, the fixed assets turnover ratio is used to determine the efficiency of fixed assets in generating sales. Companies that uh, more efficiently use their fixed assets enjoy a competitive advantage over their competitors. An understanding of what is and isn't a fixed asset is of a great importance for the investors. And it's also impact the evaluation of companies' financial position. Examples of fixed assets are land, means piece of land, plot, machinery, building and facilities, vehicles, furniture, computer equipment, means any electronical appliances, and tools or equipments. Moving forward to the next item of accounting equation, and that is liability. Liability, debts payable to the outsider, the obligations of the outsider in your business, the claim of the outsider in your business. A liability is something a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. Liabilities also have two types: current liabilities and long-term liabilities. Current liabilities are those which are to be settled within 1 year, and long-term liabilities are those which are to be settled after 1 year. Now moving to the next point, and that is equity in accounting equation. The share of the owner, the claim of the owner to the assets of the business. It is also known proprietorship or owner's equity. Equity is the amount of money that a company owner has put into it or he owns. On a company's balance sheet, the difference between its liabilities and assets shows how much the equity of a company has. The share price or a value set by evaluating experts or investors is used to figure out the equity value. This account is also called owner's equity account or proprietorship account. In simple words, equity means investment of the owner, amount of the owner in the business. As we know that any business aims to produce some net profit, some net income. How this net income generated? Net income has two components: revenues and expenses. If revenues are exceeding the expenses, there will be net income in result. And if their expenses are more than their revenues, it means that firms is suffering net loss. So the question arises that what is revenue and what is expense? Revenues, the basic definition of revenue is the total amount of money bought in by company's operation measured over time or set amount of time. A business revenue is its gross income before subtracting any expense, profit, or total earnings. It is a financial gain through sales or service rendered. In simple words, it is a financial gain through sales of merchandise or provision of services. If business is concerning to sale of merchandise, it means it is a trading business. The source of revenue will be sales revenue. And if the business is concerning to service provision, the revenue type will be service revenue or interest revenue or dividend revenue or maybe fee revenue or rent revenue, etc. Provision of services and sale of merchandise, whatever you get is your revenue. Now the next and the last item of today's lecture is expenses. In the process of generating revenue, whatever is gone off, whatever you expires, whatever you give to someone else is your expense. The outflow of assets or increasing liabilities in the course of delivering goods or services to the customer. It is the expired cost of assets and expenses in the daily routine of a business are normally rent expense, salaries to the staff, advertisement expense, Utility expenses means expenses of electric, gas, internet, etc. Interest expenses or tax expenses, any type of tax. There may be property tax, sale tax, etc. etc. So this is a end of the first lecture. Thank you very much.